Welcome to this video, where we break down the essentials of investing. Whether you're new to the market or looking to expand your knowledge, understanding different types of securities is key to making informed financial decisions. Today, we'll cover debt securities like bonds, the fundamentals of stocks and mutual funds, and even dive into ETFs, options, and futures. Let's dive in. Debt securities, investing in stability. Debt securities are a way for corporations and government entities to raise money. Investors who buy them are essentially lending money in exchange for interest payments. Bonds, the foundation of debt investing. Bonds are a common type of debt security. They pay a fixed interest rate at regular intervals and return the principal amount when they mature. There are several types of bonds. Government bonds are issued by the U.S. Treasury, as well as state and local governments. These include Treasury bills, Treasury bonds, and Treasury notes. The biggest advantage? They're backed by the full faith and credit of the U.S. government, making them one of the safest investments available. Municipal bonds are issued by state, city, or county governments. General obligation bonds are backed by tax revenues. Revenue bonds are tied to specific projects like toll roads or public utilities. Corporate bonds come from businesses looking to fund growth, whether that's building new facilities or expanding operations. These tend to offer higher interest rates but also come with greater risk. Another way to invest in bonds is through bond funds, mutual funds that hold a mix of different bonds. The level of risk depends on the types of bonds in the fund. Equities, owning a piece of a company. Unlike bonds, equities, better known as stocks, represent ownership in a company. Investors can benefit in two ways: capital appreciation, when stock prices rise over time. Dividends, regular income paid out by some companies. Types of equities. Common stock gives shareholders voting rights and a stake in company profits. Preferred stock comes with priority for dividends but usually no voting rights. Stock mutual funds and ETFs allow investors to buy a collection of stocks in one transaction. Stock options and futures contracts provide opportunities for advanced trading strategies. Different kinds of stocks. Growth stocks belong to companies expected to expand rapidly. They typically don't pay dividends, as profits are reinvested. Income stocks provide steady dividends and are popular among retirees. Value stocks are considered underpriced but have strong financials, making them potential bargains. Blue chip stocks are well-established, financially sound companies with a history of stability and growth. Ways to invest in stocks. You can buy stocks through full-service brokers or discount brokers online. Some companies offer direct stock purchase plans, allowing you to buy shares without using a broker. With dividend reinvestment plans, DRIPs, you can automatically reinvest your dividends into additional shares, compounding your investment over time. Stock mutual funds. Diversification made easy. Mutual funds allow investors to pool their money to buy a variety of stocks, offering instant diversification and professional management. One key concept to know is net asset value, NAV. This represents the total value of the fund's assets minus its liabilities, determining the share price of the fund. Types of mutual funds. Growth funds focus on companies with high potential for stock price increases. Income funds invest in dividend-paying stocks to generate steady cash flow. Index funds track major market indices like the S&P 500, often with lower fees. Sector funds concentrate on specific industries such as technology, healthcare, or energy. Exchange-traded funds, ETFs, the best of both worlds. ETFs work like mutual funds but trade like stocks. That means you can buy and sell them throughout the day at market prices. Why investors like ETFs? Diversification, they spread risk across multiple investments. Lower fees, especially for passive funds that track an index. Flexibility, since they trade like stocks, investors can react to market movements in real time. However, ETFs can have price fluctuations, and in some cases, the market price may differ from the actual value of the assets they hold. Stock options give investors the right, but not the obligation, to buy or sell a stock at a specific price within a certain period. Two main types of options. Call options give the right to buy at a set price. Investors use them when they expect stock prices to rise. Put options allow investors to sell at a set price, making them useful when expecting stock prices to fall. Key features of stock options. Lower cost compared to buying shares directly. High-risk strategies like naked options can result in significant losses. Example of stock options in action. Imagine you own shares of ABC Company, currently trading at $100 per share. You decide to sell a call option for $2 per share, agreeing to sell your stock if the price reaches $120 within the next 90 days. If ABC's stock stays below $102, you keep the option price as profit. If the stock goes above $120, you must sell at that price, missing out on any additional gains. Options can be powerful tools but also come with risks, especially when used in high-stakes strategies. Futures contracts. Predicting the market. Futures are agreements to buy or sell commodities or financial instruments at a set price on a specific date. Common futures markets. Agricultural products like wheat, corn, and soybeans. Energy commodities such as oil and natural gas. Metals like gold and silver. Financial instruments including treasury bills and foreign currencies. Futures can be used for hedging risk or speculation, but they carry significant financial exposure, making them best suited for experienced investors. Investing comes with opportunities and risks, but understanding the different types of securities can help you make more informed decisions. Whether you're looking for the stability of bonds, the growth potential of stocks, or the strategic flexibility of options and futures, there's a wide range of ways to build your financial future. Thanks for tuning in. See you next time.